Hello and welcome back to Intelligent Investment Today. This is the podcast where we explore the timeless principles of value investing. The ideas that will help investors navigate markets in both good times and bad times. Many of these ideas and principles were laid down by the father of value investing, tutor and mentor to Warren Buffett. We are talking about Benjamin Graham. Much of what we discuss on this podcast is related to stocks, undervalued companies, intrinsic value, and the concept of margin of safety. But the principles that Graham developed were never limited to stocks alone. They were designed to help investors think rationally about any financial asset, to separate investment from speculation, and to recognise when price and value begin to drift dangerously far apart. And today we're going to apply those principles to something Graham never encountered during his lifetime: cryptocurrency. Over the past decade or so, digital currencies such as Bitcoin have generated enormous excitement. Supporters describe them as revolutionary. Critics see them as speculative. And markets, as usual, have swung enthusiastically between optimism and panic. So in this episode, we're going to explore a simple but vital question. What might Benjamin Graham have made of cryptocurrency? We'll take a look at three things. Firstly, we'll briefly revisit Graham's famous definition of what actually qualifies as an investment. Second, we'll examine whether cryptocurrencies meet the key tests Graham believed every investor should apply: analysis, intrinsic value, and safety of principle. And finally, we'll consider where cryptocurrency might fit with Graham's broader distinction between investment and speculation. Because while new technologies may appear, and markets will continue to evolve, the fundamental principles of sound investing rarely change. So, as always, sit back, tune in, and get ready to take on board another lesson in value investing as inspired by Benjamin Graham. Let us begin with Graham's famous definition of an investment. In The Intelligent Investor, Graham wrote that an investment operation is one which, upon a thorough analysis, promises safety of principle and an adequate return. Operations not meeting these requirements, he concluded rather bluntly, are speculative. It is of course a wonderfully concise definition. Three elements are required: analysis, safety of principle, and a reasonable expectation of return. Now let us imagine a Benjamin Graham examining cryptocurrency through this framework. The first question he would surely ask is, can the asset be analysed in a meaningful way? For Graham, analysis meant examining the underlying value of a security. When analysing a company, you can look at earnings, assets, cash flow, competitive advantages, and long-term profitability. These factors allow an investor to estimate what Graham called intrinsic value, the actual underlying economic worth of a business. And once this value has been estimated, the investor can compare it with the market price. If the price proves to be sufficiently lower than intrinsic value, the investor has found a potential bargain. But when we turn to cryptocurrency, the analytical process becomes rather more complicated. A share of a stock represents ownership in a productive enterprise. A farm produces crops, a factory produces goods, businesses produce profits. A cryptocurrency token, on the other hand, produces very little, if anything, in the way of measurable financial output. It does not generate earnings, it does not distribute dividends, it does not produce cash flow, and it does not represent ownership in a business that sells goods or services. It simply exists, recorded on a digital ledger. Now, while that ledger may be technologically interesting, and it may even have useful applications, from the perspective of traditional financial analysis, Graham would likely ask a rather uncomfortable question. Where are the cash flows? Value investors rely on the idea that an asset ultimately derives its worth from the income it can produce. Without such income, valuation becomes far more speculative. And when valuation becomes speculative, investment begins to drift towards speculation. To be fair, some other assets also derive value from scarcity rather than productivity. Gold, for example, has been valued for thousands of years, despite producing very little in the way of earnings. But even gold tends to be viewed as a store of value rather than a productive investment. And gold has at least one advantage over most cryptocurrencies. It exists physically. You can hold it, you can melt it, you can make jewellery out of it. Cryptocurrency, by contrast, exists entirely in digital form, which means its value ultimately depends on one thing above all else: confidence. Or perhaps more accurately, collective enthusiasm. And enthusiasm, while occasionally profitable, has never been particularly easy to value. The second element of Graham's definition is safety of principle. And this is where Graham's most famous concept enters the discussion: the margin of safety. The margin of safety, as regular listeners will be well aware, is the idea that an investor should buy an asset at a price significantly below its intrinsic value. This gap provides protection. If the analysis turns out to be slightly too optimistic, the investor still has a cushion against loss. But in order to have a margin of safety, one must first estimate intrinsic value. Without intrinsic value, the margin of safety disappears. And when the margin of safety disappears, investing becomes something else entirely. With cryptocurrencies, determining intrinsic value is notoriously difficult, if not impossible. Investors often justify prices based on future adoption, network growth, or the possibility that digital currencies may one day replace traditional financial systems. These may or may not be valid possibilities, but they are virtually impossible to quantify. And Graham was deeply sceptical of investments whose valuation depended primarily on optimistic forecasts about the future. He preferred assets whose value could be measured in the present. The cryptocurrency market, by contrast, often behaves less like a valuation exercise and more like a popularity contest. Prices rise because people want to buy. They fall because fewer people do. The third element in Graham's definition is the expectation of an adequate return. Traditionally, investment returns come from the productive capacity of an asset. A business earns profits, those profits grow over time, and shareholders benefit from that growth. Cryptocurrencies, however, typically rely on price appreciation alone. The investor buys today, hoping that someone else will pay more tomorrow. Now, markets have always contained this element. Speculation is not new. And Graham openly acknowledged that speculation is a natural part of financial markets. But he warned investors about confusing speculation with investment. He argued that if investors wish to speculate, they should do so with full awareness of the risks involved, and preferably only with a small portion of their capital. In other words, speculation should be treated as entertainment rather than financial planning. And the cryptocurrency market has certainly provided plenty of entertainment. Prices have soared dramatically, and they have collapsed just as dramatically. Entire exchanges have vanished. New tokens appear regularly, some with names that sound suspiciously like internet jokes. And one cannot help but imagine Benjamin Graham observing this spectacle with polite but unmistakable scepticism. Graham spent much of his career studying the psychology of markets. He understood perfectly well that investors are prone to periods of enthusiasm when rational analysis takes a backseat to excitement. These episodes often end the same way, with profound disappointment. So where does Graham's idea of Mr. Market fit in? Cryptocurrency markets sometimes appear to consist almost entirely of Mr. Market on a particularly emotional day. Prices swing dramatically, narratives change overnight, and investors frequently find themselves caught between the fear of missing out and the fear of losing everything. And neither of these emotions tend to produce particularly sound financial decisions. None of this necessarily means the underlying technology is without merit. Innovations often emerge in surprising places. But Graham's chief concern was never technological novelty. It was financial discipline. And this discipline requires asking some rather uncomfortable questions. What is the asset worth? How reliable is that estimate? And does the current price provide a margin of safety? If those questions cannot be answered clearly, Graham would almost certainly advise caution. Perhaps considerable caution. After all that's been said and done, the central lesson of value investing is not about predicting the future. It's about protecting capital. Investors who manage to preserve their capital have the opportunity to invest again tomorrow. So where might cryptocurrency fit within Graham's framework? He would, not surprisingly, almost certainly classify it as speculation. Not necessarily forbidden, but certainly not something to be confused with investment. And if investors chose to participate in it, Graham would probably offer one simple piece of advice. Know what you're doing, know why you're doing it, and above all, know the difference between investment and speculation. Because that distinction, more than anything else, lies at the very heart of intelligent investing. And on that, we draw this edition of Intelligent Investment Today to a close. I hope it's been fun, and this look into cryptocurrency through the lens of Benjamin Graham's principles has reinforced the idea that intelligent investing isn't about chasing whatever happens to be fashionable at the moment. It's about applying careful analysis, maintaining a margin of safety, and keeping front and foremost the difference between investment and speculation. Because while markets will always produce new ideas, new technologies, and new opportunities, the principles that protect investors from unnecessary risk tend to remain remarkably consistent over time. If it's been worthwhile, do consider subscribing or adding us to your playlist so you'll be reminded whenever a new edition lands on your platform. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.